Hello, MakerDAO community, and welcome to the 11th session of Focus On. I'm Retro from the Sustainable Ecosystem Scaling Core Unit, and today I'm excited to be joined by New Silver to give a update both on the housing market as well as a quick recap of the past year of New Silver serving as the first real-world asset onboarded by MakerDAO. The 21st of April 2021 was the first DAI minted on chain backed by real world assets by New Silver. And today, as I mentioned, they'll discuss the macro and microeconomic trends affecting the US real estate markets and discuss some strategies about how they're planning to navigate the environment. As a quick reminder, please drop your questions into the chat and we'll answer them towards the end of the call, or use the raise hand feature of Google Meets. So with that, I'll turn the mic over to Kirill.
Awesome. Thank you so much for that introduction. So my name is Kirill Bensonoff. I'm the CEO of New Silver. Also on the call with us from the New Silver team, we have John Curry, who is the head of capital markets, and Alex Shlayetsky, who is the head of risk. So they'll be able to answer questions if there are some for them. But I'm going to share my screen and go through a quick presentation and then take questions afterwards. Sorry about that. 1 second. All right. Can you guys see my screen?
Yes.
Excellent. Okay. Cool. So just a quick overview. We're going to do a quick company update. We'll talk a little bit about the real estate trends and what's happening in the macro and the micro economic world. And we'll talk about what New Silver's future planning looks like. And then we'll do the questions, as I mentioned. So yeah, we've turned one. So I remember doing this AMA a little bit. I believe it was in April of last year, sometime around the first DAI was minted, I believe. Year flew by. Obviously, it was it was not an easy year necessarily for the world in general, but the markets in the U.S. and in general were favorable for part of the time, and now things are changing. But we were excited. We're still excited to be the first real world asset and the first pool on Centrifuge, the first real world asset to partner with MakerDAO. So essentially, we've done a lot of things together in the past year. We're still, I believe, the largest real world asset pool at the moment. We've had no defaults since we started. The current, I believe, revenue that I was able to check last week was north of 500,000 DAI per year, coming from New Silver specifically. We've essentially done a lot to improve our process and continuing to improve our process, and we've learned we've put together a nice ability to scale our business, and that we think we have an attractive and inclusive offering for well-qualified borrowers, meaning on the borrower side, the real estate investors that essentially come to us to borrow fiat at the moment. And hopefully at some point in the future it'll be a stable coin DAI, hopefully. And but we today we have a nice offering, I believe, that is attractive for both borrowers, and we're also working on an offering for other smaller lenders that may originate similar types of loans that we have today, and essentially be able to purchase and provide liquidity for these smaller lenders. So as of, I think I created the presentation a few days ago, it may be slightly different today, but we're using somewhere around 17 million of Maker debt ceiling out of the 20 million available. So around 85% or so debt utilization. And Maker is currently holding about 69-70% of the drop share. So we have a number of other co-investors holding the senior shares. So kind of start talking about the real estate markets in general in the U.S. and probably in a lot of the world. We've seen obviously a lot of inflation over the past year. There was a lot of liquidity created by the Fed during COVID and I guess throughout COVID. And that resulted in, or continued to result in inflation. Not only that, but I think the overall, breakage of supply chains and other macroeconomic trends are continuing to weigh on the inflation, and inflation has been fairly rampant by historical standards. So as far as mortgages, and here I want to kind of delineate between the loans that we do, which our loans are also collateralized by real estate. However, they're not consumer mortgages. They're not for people to live in these homes, right? We lend to real estate investors, typically for 1 year, and the purpose of that lending is for them to renovate the property and then resell that property, or rent that property out to create a passive income situation for themselves, or have some kind of an exit afterwards. So our loans are not permanent facilities. They're short-term construction financing in most cases. And so, when I talk about mortgages, I'm going to delineate between consumer and the commercial style mortgages, business purpose mortgages that we do. But the consumer mortgages are typically tied to a 10-year treasury bond, and the yields on those have increased, and they're at 5.06, as of April 21st, probably even higher as of today. I have not checked today. And so that pushed the overall consumer mortgage rate on the average in the U.S. This is the 30-year conforming rate for, let's say, an average price home, which is about $350,000, to somewhere around 6%. In some cases, above 6%. In some, highly qualified borrowers, perhaps a little bit below 6%, but it's right around 6%. And here I have a graph. This is from like a sort of a historical. I wanted to find a historical graph of how the mortgage rates, which are shown by the sort of the grayish colored line here, and as we could see, like in the 2000s, it's somewhere very close to zero, and in the 80s, it's higher, up to like 15-20%, and how that compares to the Fed rate. So I think we'll talk a bit about that going forward. As far as what do the numbers look like? So from 2008, because I think, kind of to take a step back here, we've had a number of specifically real estate crises, or other crises that have kind of resulted in real estate price changes, right? In the last one, the big crises that led to a recession in the U.S. and worldwide was in the 2008 to 2013 timeframe. So, the sector that we're in is, I guess, I don't like this term really, because it has changed a lot since then, but some refer to it as hard money, right? Because I think the space originated in the 90s with people lending out actual cash. I mean, we don't lend out actual cash. I mean, the process has institutionalized and turned into something very different today. But in the research that I did was on like hard money lenders, and how did they perform from 2008 to 2013. And so, the research that I found, and there's not a huge amount of, this data does not necessarily get reported anywhere. The research that I found, that I have links to, I believe I put it on the forum, and I could share, it'll be shared in this presentation as well, is that the overall defaults were averaging around 1% in that time frame in the hard money lenders that we were able to find through the research. And also, I just want to point out that the situation is quite different today than it was in 2008. And the situation that precipitated that crisis in 2008 was speculation in the real estate market, bad underwriting, and various processes like appraisals that were communicating directly with the borrowers, and sort of increasing price, based on the demand of the borrower, and underwriters and brokers kind of all playing the same game to increase price and continue to originate mortgages. Much looser underwriting standards. They're quite different today, right? Again, in the consumer world, these types of mortgages for the most part don't exist. Appraisers no longer talk directly to borrowers. Everybody uses an appraisal management company, as we do as well. And so, the situation is quite different. And also on the housing supply, right? During that crisis, I found the housing supply was around 9 to 12 months, whereas today it's way below 6 months. So it's probably around 2 to 3 months on the average. So the supply is much tighter. That is not necessarily a good thing. So I'm just trying to paint a picture that the situation is very different today. But even with the defaults that occurred in 2008 to 2013, our research shows that they were right around 1%. So we think, at the moment, that the lack of supply will continue to drive price appreciation or price stability, right? So, we don't necessarily think that prices are going to continue to go up like they did last year, but they will, and most predictions show that they're going to continue to go up, a little bit more, but we're hoping for a slowdown in price appreciation and, sort of price stability coming in towards the latter part of the year. And housing certainly has become a lot less affordable, and especially with the rising mortgage rates, it is, it's even less affordable, right? Because, I believe for every $100,000, the average is something for every 1 point increase, I want to say it's something like $250 extra per month that someone has to pay. And don't quote me on those numbers, but as the price of mortgage goes up, the cost to the consumer or the borrower that's buying the property, but potentially buying the property from our flipper, goes up as well. Banks have also loosened some of their underwriting standard. We keep a close eye on that. And they have loosened some of their underwriting standards. However, they're still not even close to where they were in the pre-2008 levels. We also pay attention to the remodeling activity. So this is something that the Harvard's Joint Center for Housing Studies puts out once a quarter. So this is the chart to the right. And we see the projections from, Q1, which just ended here, into, Q2, 3, and 4. So we see that, things are starting to slow down towards, at least the expectation of things starting to slow down towards the latter part of the year. There's two different types of projections. Red line and the charts here are two different types of projections, and I'll have a link over to the study. It's actually right here, but you guys could check that out as well. So we think about the remodeling projections as sort of a leading indicator of where things may stand with the construction activity that our borrowers undertake, and when and if there's a slowdown expected. So what are our thoughts and actions, and what have we done, and what are we thinking about doing? So again, as I mentioned before, we don't necessarily anticipate real estate prices to decrease over the next 12 months. So we're not, because our loans are typically 12 months in duration, the average payback is right around 5 months as of right now. So we're kind of projecting for the next 12 months out. So we see some price stability coming into the picture, and less price appreciation, but not necessarily a price depreciation. And then we're also taking steps to make sure that we're prepared for potential issues as they can kind of happen fairly quickly in the market. So we're tightening our underwriting standards. We're going from a minimum credit score of 620 to 650 for experienced borrowers, and up to 700 for borrowers without experience. Our portfolio average credit score is above 700, so we're in the quote unquote prime category right now. So our average FICO score is actually pretty good. We're not in the subprime category. We're in the prime category, but we're tightening this up even more to sort of anticipate any potential issues. We're also decreasing the loan to cost on heavy rehab loans to 85% from 90 for non-institutional level borrowers. So institutional level for us means when someone has done 10 or more projects in the past 36 months. So so this is going to affect the vast majority of the borrowers. So we're going to go down to 85%. We also have this profitability test that we've been using, from day one, but we're now kind of tightening it up a little bit as well and putting in a 5% potential correction on the pricing. So the profitability test is essentially us looking at the project, the loan, the construction costs, and the after rehab value that the appraisers give us, and then figuring out if there's enough cushion in there for the project to be profitable, right? So we want our borrowers the ability to make at least $10,000 or hopefully higher. I mean, I think the average is around $60,000-$70,000 throughout the country, put out by Adam, which is a data analytics company in the real estate space. But we want them to be able to have a profit at the end of the day. And when we look at this profit, we're putting in this 5% potential correction, and that's kind of how we look at it, going forward. We're also paying close attention to material pricing. Obviously, some of the materials have doubled in price. The price per square foot has gone up significantly. The borrowers provide us budgets. We review those closely to make sure that the materials are priced approximately correct. I mean, we can't price it to exactly, but we look at the budgets and we make sure that the pricing is valid. And then there's some cushion in there. We want to see a line item that says, unanticipated costs, and then there's some percentage, and Alex can probably expand on that a little bit more. He has those numbers if you guys have questions there. And then last but not least, and the changes that we're making is we're thinking about other ways that our potential borrowers can exit, right? So traditionally we lend for 12 months, they do their renovations and they resell to a consumer, or sometimes they resell to another real estate investor that's gonna essentially convert that property into a rental unit, or sometimes they refinance themselves and then convert that property into a rental unit that they can get tenants and make money that way. And by the way, when we look at the profitability test, if we know that they're going to be doing that, then we look to make sure that they can get that kind of a loan, an investment property loan potentially, and then that the investment property makes sense, that there's some kind of a capitalization return on that property when they turn it into a rental unit. We know the average rental prices for this type of property in the marketplace. So we look at that. But aside from this, we're also talking to a couple of partners. One of them is Lofty AI and the other one is Roofstock. They have slightly different models, but Lofty essentially fractionalizes and sells those fractions, as essentially fractional ownership. So they take single family homes around the country. I think they've done over 100 or hundreds of these types of properties, and they're also blockchain enabled. I think they work on the Algorand blockchain, and so they take those properties and they turn them into fractional ownership shares, and they sell those tokens to investors, and then they provide them a return from the rental income on those properties. And then Roofstock essentially takes the whole property and they sell them to one investor, and then they do property management and other things. So we're talking to these two, and then we have a couple others on the horizon that will provide sort of a quote unquote wholesale channel for our borrowers. Even at the start of the loan, we could give this borrower a potential pricing on a property that they may sell, and even go as far as to sign a purchase and sale agreement for a finished product before they even start their work. Obviously, there's going to be conditions, timeframes, things like that, but they'll give them some certainty to exit. So I think the real estate markets have changed with technology quite drastically. And so, we think that the traditional exit channels, which I mentioned before, and coupled with these newer sort of tech-enabled, tech-driven potential channels to either fractionalized ownership, resale to a potential landlord, real estate investor who's going to use it as a rental unit, those all open up opportunities for our borrowers in case they're having trouble selling it to a consumer because of high mortgage rates or something like that. So I'll touch on just sort of the new silver planning for future, and then we could take questions. So we signed a $20 million term sheet for a mezzanine facility with an institutional investor, $2 billion plus AUM investor that's going to help us essentially scale our pool and hopefully increase the debt ceiling with MakerDAO, and they're going to come in as at the mezz level. So we're still structuring that, but we've done this quite recently. We're continuing to grow our team. I think we're up to 15 people now. We're hiring for key roles in underwriting and in the loan management, loan processing, post close, things like that. So we'll have we're continuing to institutionalize and improve the process that we have today. We're also working on some green initiatives. Still kind of in fairly early stages, but we have some thoughts that probably not ready to share at the moment, but we will be sharing over the next month or two. That's going to hopefully help us drive our borrowers that are doing heavy rehab construction to more green friendly, environmentally friendly materials and building in an environmentally friendly way, and we'll be able to incentivize that for them. And continuing to improve our legal framework. Obviously spent a lot of time, and thank you to the Centrifuge team and to the RWA team, of course, as we're kind of reworking and improving what we've started with last year. And I think we'll also be ready to share some of those components shortly. And we're hoping to ask the community in the near future for a debt ceiling increase once we have the legal put together, and obviously all the other efforts that we've been working on. That I think is it. So we're happy to take questions.
Yeah, thank you for the wide overview there. It was very interesting to see how your team is proactively looking at the market and making those corrective changes. The first question that I have would be related to the credit score tightening. That seems to me like a good indicator that you guys are maturing. As the market improves, do you see the opportunity to take on more risk then? Is that time frame 12 months out that you're seeing, and or would that potentially be longer?
I think it's going to be hard to say, and again, because every crisis is different. We're not in a crisis right now in the real estate world, right? We're more of an inflationary period. And so, things are costing more and more. Housing prices are eating up more and more of consumers' budgets and so forth. So how long is that going to last? And certainly salaries are also on the increase, right? It costs a lot more. Like salaries have increased overall. I mean, we were just recently and if we're kind of thinking about because our borrowers are typically sort of in the lower to middle markets, right? We're not too much involved in like luxury homes necessarily, like very occasionally. So we kind of focus on the average price home. Maybe it's just the first or second home that a family buys. So how long is that gonna last? I mean, our salaries, our disposable income is gonna increase and catch up a little bit with what the housing costs are. We're not certain, but I think for the short term, right, we want to be where we are today. I think that with the new credit scores, I think that our vision is to be as competitive as possible on the rates, and thus draw in the best, the most qualified, the most experienced borrowers, and kind of compete that way rather than sort of continuing the downward trajectory and taking on more and more risk, right? Though again, FICO score, it's a great indicator. It's been used for many years and has gone through a lot of transition, and everybody in the U.S. still uses it to offer credit when making credit. But it could also change very quickly, right? Like if someone's got a 700 score today and they miss a payment, they could be at 600 the next day, right? So it's all very fluid. So yeah, hopefully that answers your question. Maybe Alex can add a bit on that.
Yeah, just to add, I mean, not all credit scores are created equal, as they say. So we dig a little bit deeper. We look at the actual credit report, because different agencies have different algorithms. They score it differently. We do a tri-merge pool, which has all three credits. Sometimes the credit gets dropped down because of high debt utilization, which we see a lot from the contractors that use their own credit cards to kind of buy materials up front and then pay at the end of the month. So you can have a 100-point swing from the beginning of the month until the end of the month when the bills get paid. So we look at that also. But we look at other things in combination to make a decision, experience, project itself, and location, many other factors. We pull a lot of data on every project, including the location and even the census data. So that all plays part in the decision making. But there have been so many studies done on credit analysis and categorizing these credit scores. I think that 650 is anywhere from 620 to 650 is where the prime, good credit starts. Really, it shifts in some cases, but I think that we're just trying to be a little bit more proactive, again, to attract the top tier borrowers, because we want to be the most competitive on the rates, like Kirill mentioned. Yeah.
Yeah, and one other thing I want to mention, the 650 credit score, the studies I've seen, and again, it's difficult because there's different asset classes. An unsecured loan is very different, right? Like, is someone going to repay an unsecured loan over a collateralized loan that they may lose, a lot of money that they put into it and a lot of work as well. We don't know, right? We don't know each individual's thinking, but the 650 credit score seems to be like where things drastically change, right? So like if you look below 650, the repayments are very different. Like the default rates tend to almost double from the 650 and above. So we think 650 is that floor. And again, there might be some cases where this 650 can be there could be an exception done for a specific borrower, but we think that's where the average should be.
Makes sense. No, I definitely appreciate that context. Quick
Thank you.
reminder, if you guys have any questions in the audience, please feel free to type them in the chat or use Google Meet's raise hand feature to hop on the mic. Oh, perfect. Go ahead, Tej.
What's up, guys? Thanks for the presentation. Thought it was really well done. To kind of follow up on Retro's question regarding credit scoring, I agree. Love to see that things are tightening a bit as kind of risk and volatility increases. It's the way to do it. In terms of this line in the sand between quote unquote borrowers with experience and without, what's the science behind that?
Yeah, I mean, I can say a few words. I mean, there is not hard science, honestly, behind that. We've kind of looked at what our competition is doing and what we've done through the past couple of years. And experience does play a part in how people can potentially execute these projects, right? But it's also kind of subjective, right? So if somebody was a subcontractor on a specific project, but they have an overall business sense. Maybe they studied business in school, or maybe they're just business savvy, right? Are they able to execute as well as somebody who has built 10 projects themselves? Very likely so, right? But we've kind of chosen to delineate anyone that's done 2 or more projects and counting them as experience, right? Anyone with a 0 and 1, counting them as not experienced, and just kind of being a little bit more careful. Their average leverages have already been lower before. That we've always had that, so we don't give them as large of a leverage loan as we do somebody with experience. But frankly, I don't know that there's hard science. Maybe Alex can weigh in as well.
Yeah, I mean, yeah, like Kirill mentioned, it's very subjective. It's also based on our experience with the borrowers, because we've seen, thousands of them already. We also differentiate between the rehab level, right? It's not, rehabbing a property and flipping a house. It's not rocket science, really. I mean, most people with a property have done some level of rehab in their lives, and they're very familiar. But it's a different type of project if you're just doing cosmetic rehab or just changing, kitchen cabinets or whatever, from like a full down to the stud, flip, or a very significant construction. So we do differentiate between those. We do have experience requirements for heavy rehab ground up construction, whereas we can work with the first time, quote unquote, investors on a lighter rehab. But we also look at overall, level of, I guess, potential success. I mean, we even ask borrowers their education level when they complete applications. I mean, if someone has experience and, in finance, for example, then chances are they will be successful. But we also, on bigger projects, we always ask for contractors' licenses if they work with an outside contractor, to make sure the contractor has experience. Because, you can have investment experience on the management side and can, use a hammer, and that's totally fine, right? I mean, we have different levels of borrowers. We have smaller types with the husband and wife team, where a wife is a real estate agent and the husband is a contractor, and they can do, one or two side projects a year. Or we have institutional level borrowers with like multiple crews that do like 5 projects at the time, and this is their full-time business. So we do look a little bit deeper at this. But yeah, I haven't really seen any institutional level studies on the data, how experience affects it. It's more of a subjective experience feel,
Yeah.
Yeah.
That makes sense to me. There's only so much of, especially with something like real estate, where it's really driven by the people executing, right? And part of it is underwriting how those people will execute, and that's a human thing. It's not a science thing. I guess the other piece is, it strikes me that when we think about our leverage levels, right, with this sort of loan, you have LTC and LTV. With the LTC, it seems like you guys are underwriting a little bit tighter there, which makes sense as a hedge against budgets blowing out, right? Both because of wage inflation of contractors and because of materials. But it strikes me that a risk that we, like a shift in thinking, at least how I think about it, is, with mortgage rates going up, you actually might have values pull in, right? So the LTC might look conservative vis-a-vis the inflated budget, right? Which is interesting. But the LTV calc also kind of tells the full story as well, right? Because you can expect, all else equal, for the value on the end asset to drop, right? Because your takeout, whether it's refi or someone buying out the property, money is now harder to get, right? So how do you guys think about, when you underwrite, what weights you're giving to LTC versus LTV as we kind of shift into a new rising rate environment?
Right. So I can take that one. So we look all loan structure. The LTC really reflects to us the skin in the game for the borrower, right? The ones that are very, very experienced and know what they're doing and can budget better, we need at least 10% equity from the project, cash equity upfront. The others, this is where the 85 LTC reduction comes in place. We want more skin in the game from them so that they're more involved. But overall, the loans are structured based on the ARV, which is the as repaired value per the appraisal. So we don't go above 75% generally of the ARV, meaning that the total loan amount with the construction cannot be above 75% of the finished value. I think our average is below 70 potentially, but 75% is the absolute max. So we have a 25% cushion on the value built into the loan, which means that even if the market drops 20%, which in reality on a short-term loan like this, it's very, very low probability of that happening, we could still be above water on the loan amount. Then we also use the 5% profitability test to make sure that it's still profitable, even if the prices drop even 5% more from where we're anticipating. So I think as far as the risk, we're well protected with that 75% ARV. Again, these are not long-term consumer loans. I mean, 30-year loans, 10, 15-year loans, a lot can happen in that time. But with the 5-6 months average and the 12 months max term, even if the prices dropped by 10%, okay, so we still have a 15% cushion left. So this is why Kirill cited those statistics that, we've looked at the big short-term bridge loan aggregators with $1 billion a year volume. And during the very stressful time, and even during COVID, they had less than 1%, I think, defaults. And the actual principal loss was a fraction of that, very, very little, because of those 75% ARV leverages on the short-term bridges. So I think we're protected in those cases.
Great, thanks, fellas. I've got like 16 more questions, but I figure let some other people talk if they're so inclined.
No questions currently in queue. If there are any other hands, please feel free to raise them. I'll cut in line real quick before Tej unloads. I just want to ask about, you said that loans are typically about 12 months. We're about at that 12-month period since your first onboarding. How are you guys seeing borrowers re-engaging with your team? Are you starting to build a client base that's consistently coming back?
Absolutely.
And any comments about that pipeline then?
Yeah, that's a big part of the business. Repeat customers, we have a lot of them, and that's kind of what the focus is on, because this is competitive business. We've built a process to make it easier and faster, and more user friendly, and that we got a lot of feedback originally that this is what the borrowers like the most. And then of course the rates, we want to be as competitive as possible, but we also have incentives built into our pricing model where they get repeat borrowers get automatic discounts based on the number of projects they've done with them. And then you obviously build relationships because we have loan originators and loan consultants that deal with people directly, and it's all about how comfortable you are with the process. And the whole process plays part in it, how fast we can do the inspections for the draws and release the funds. In this business, everything matters, because when the contractors have to be paid, you can't tell them tomorrow they'll walk off the job and go somewhere else, right now especially. So all of that plays a role in this, but we do have a lot of repeat customers. That's definitely a big part of it.
And specifically, I could say I just looked at our analytics. We have 33 loans, or 30 out of the 100 and I think 60, or I can give you an exact number, total 168. This is including open and closed. We've had 33 borrowers with 2 or more loans. So right around 20%, a little bit less than 20%, and repeat rate. Don't know what to compare it to. We don't know what the industry averages are, but that's kind of where we are.
Yeah, this statistic really shows the out of the current batch, that right now how many borrowers with multiple loans are. I think our repeat borrower ratio is higher than 20% overall. Like I said, not everyone does multiple loans within a 12 months period. They can come back after 12 months. So which a lot of them do that because this is not a full-time job for a lot of our borrowers. They just do it as a side project type of deal.
Got it. Yeah, and then a quick follow-up before happy to hand the mic back over to Tish. Do you see that as a driver of increasing the surplus buffer and borrowing from Maker, or is that just more of something that you count on for stability and confidence, knowing that the pipeline will be there? Is that pushing for future growth?
Yeah, I mean, I think. Do you mean like the repeat business specifically, or?
Yeah, like that market segment. So like is the surplus buffer going to be driven by new customer attraction and new market segments, or is it more of this repeat business that you feel? Or
Probably both. I mean, we would definitely like to do business with repeat borrowers because we get a sense of how they execute fairly quickly, right? Once the loan is originated, then they go to us for construction draws. We do inspections, so we immediately get a sense of how well they're building, how quickly are they turning things around, how well they're communicating, that kind of stuff. So this is all sort of subjective relationship type of stuff that is still plays heavy into our business. So we definitely love to do business with repeat borrowers because if we only take on obviously ones that are. I don't think we've had any issues with borrowers coming back that we weren't able to lend to. I think all of our repeat borrowers are ones that are like really hardworking and really understand what they're doing, goal oriented and things like that. But we also obviously have to go out after new business as well to continue to attract new borrowers and in different geographies. I mean, we haven't necessarily touched all of the geographies in the U.S.
Yeah, no, we love repeat borrowers, of course, because it also drives our costs down. We don't have to spend money on new customer acquisition, and we spend less money on underwriting because we have most of their documents on file already. So it's a faster process for us that it requires less money spent. But when we go after new areas and advertise more, then with the hopes of create repeat borrowers in those areas as well. So yeah, it's both of those.
Definitely makes sense. Tish, if you have any other questions.
Yeah, I mean, I guess going forward, in terms of the new silver product, is the intention to originate fixed or floating or both? And is the intention to stick within kind of the single family resi wheelhouse or widen the aperture?
Yeah, I mean, I think we haven't studied a variable rate model, to be honest. And I think all of our competition that we know of, the 1-year loan is typically fixed, right? So and it's interest only. So people want to kind of have a certainty of what their costs are going to be for that 1-year duration. So I don't know if doing like a variable rate for a 1-year will be competitive or not. We haven't really studied
or price
it,
effective. Yeah, it's just yeah.
And then as far as the second part of your question, we like the resi space. I think we touch a little bit of like multifamily, slightly larger than 40 units. We don't think that's going to be the majority or the driver of our growth. I think what will drive our growth is the ability to execute quickly and efficiently, having that certainty to execution. So when someone applies, then there's a high certainty that they'll get what they see that they're getting. We give them the term sheet online and things like that. That's the technology that we built, and people really love that. And obviously having a very competitive rate and then being able to attract the best borrowers and the least risky business is the other part of it.
Yeah. Just to add to that really quickly, I mean, the single family per se, I think it refers in lending more to like 1 to 4 families. This is all in the same category. I mean, we like the space because A, it's a lot easier to appraise, and B, I think it's a lot more predictable than some of the others. I mean, I have some commercial real estate experience, a lot of it actually, and I mean, Not only commercial properties are a lot harder to appraise, but there's a lot more volatility there. You can have a retail anchor tenant that moves out and you lose 60% of your income for 5 years. So it's impossible to appraise quickly. We like to use technology. We look at a lot of data. All of that would be a manual process for those types of deals that we're not really interested in. It's very difficult to scale and the risk is higher. So
in as much as we can, we want to remove the subjectivity of lending from our process in as much as we can. It's never going to be totally removed, right? Because like we have, for example, experience, right? Like what constitutes heavy rehab? I mean, there's not an exact delineation what constitutes the fact that they ran the project versus them being a subcontractor of some sort. And so there's always going to be some subjectivity, and sometimes we can turn a potential borrower away for, because they don't communicate well or they're rude or, I mean, that could happen as well, right? Like but again, we want to try to remove the subjectivity of our lending decisions and and use as much data as possible and provide that certainty. So if the data doesn't work with our credit box, then we tell them up front that we can't do it, and that's that. If we can do it, we want to be able to do it.
Another nice feature, if we're being honest about single family stabilized, is there's a rather large marginal buyer in the market in the Blackstone and the ilk, right?
Correct.
And they'll just buy these things up in the thousands, which politically is not ideal for our country, but for the purpose of this business, it's pretty ideal.
Yeah, we've chatted about this before. You mentioned you're familiar with that, so I think that we actually had a conversation on this subject. I think just yesterday, is that as we grow, because Blackstone. So I think like as we're thinking about like what are some of these other channels that we can partner with to enable our borrowers to wholesale these properties in case in case they want to, or in case the markets kind of turn against them during the time of the construction, right? So then we have like Lofty and Roof Stock as a great opportunity for potential wholesale, but then maybe going right up the chain, because as we all know, in the financial markets, it's rarely that the counterparties you work with is, especially in real estate and these large multi-million or multi-billion-dollar deals. There's many people involved, and the money's ultimately usually not the party that you're dealing with, right? So there's many layers to the ultimate the lender or the ultimate owner of those funds. So as we grow our portfolio, we'll be able to grow the relationships and to the likes of Blackstone or others potentially. Not necessarily our goal to wholesale everything to Blackstone and have our fix and flippers kind of be the workers for Blackstone, but as a potential opportunity that does exist and it continues to be there. I think that just personally for me, if I can add, one of the reasons I like this specific area of lending is because we enable essentially mom and pop, very small businesses. Really, our borrowers are, for the most part, blue collar mom and pop type of people that are doing this either on the side or doing this as a full-time job and are really able to make a living, by kind of learning the business in some cases, trying, and kind of doing it the right way. And so that really motivates me when I think about this business, that we're enabling some families to thrive and do better. So with that, like, what's the outlet for them? I mean, again, if they're making money and Blackstone is the buyer, okay, great. If they want to sell it on the open market to another family, probably better. So
great. That's all I got. Well, not really, but
To say that was a quick 16 questions. But no, in the spirit of time, we are at the top of the hour. I know we started a little late here. But if there are no other burning questions, what's the best way for the MakerDAO community to reach out and engage with the team if they have any follow-up?
Sure. I mean, the forums, I don't know if you guys will post the recording. I'm happy to post the presentation So I'm happy to answer questions right in the forums. My contact is, I could post my direct contact if somebody wants to email us privately. Happy to answer that way as well.
And Kirill, I think we were talking about possibly doing a version of this for the centrifuge community sometime later in an adapted form. So if there are any further questions, obviously we will also invite you all to that.
No problem.
Perfect. Appreciate that. Shout out, Janice. So best way to keep up to date is at forum.makerdao.com. Keep an eye out for future calls and engage with the team as questions pop up. I'd like to thank everybody for joining today and finding the right call link, and we'll see you in the forums. Thanks, everyone.
Thank you.
Thank you.